Maverick traders, welcome out to Fibonacci Retracements, a class where we're going to talk about mean reversion and how to use these retracement concepts, a little bit of the history of Fibonacci, just a variety of different things that we think can be a great tool in your toolbox. So let's have a lot of fun. Let's jump into Fibonacci retracements. Today I want to talk about Fibonacci retracements. And Fibonacci, this was discovered, this sequence and this mathematical process was discovered by Leonardo Fibonacci. Fibonacci actually is son of Bonacci is what that means. But anyway, Leonardo worked at his father's trading post in Africa and basically discovered this sequence. And so this sequence is, if you take any number in the sequence and add it to the number before, it gives you the next one. So, for example, if you take 1 plus 2 equals 3, right? Well, 3 plus the number before it gives you the next number in the sequence, which is 5. And 5 plus the number before it, which was 3, gives you 8. And 8 plus 13 equals, or 8 plus 5 equals 13, and 13 plus 8 equals 21, and so forth. And so you get this sequence of numbers. Now, if you were to dig into that a little bit further, in fact, you could go down a little bit of a rabbit hole of Google. And here is the website Math is Fun, and it talks about this sequence. But basically, it makes this spiral effect. And if you look at this, this is found in nature over and over again, this spiral effect. Each of these numbers basically approach phi. There's this golden ratio, and you can go down a rabbit hole of exploring the golden ratio, often referred to as God's ratio or God's number, because it's found so much in nature and all these different things. In fact, even artists will use this type of approach because it's kind of aesthetically pleasing. It's pleasing to the eye and so forth. So the reason that traders will use Fibonacci, and I always have to kind of pause here and say, look, this almost sounds like you're using lunar moon cycles. Like, how does the moon moving, and that's going to dictate whether stocks go up or down. It's not that. It's more about just, what is the market? Well, it's human beings. And where do human beings most often want to buy and sell? You know, what is going to be their approach? What is going to be, when is it going to be appealing to them? Because there's certain patterns and certain setups and so on that will cause traders to say, well, maybe I'd more like to buy here than sell. And so if this Fibonacci, if this retracement idea is kind of pleasing to the eye and there's more reasons to buy than sell, it might give us a little bit of an edge. This is not something that you can just fall back on as if it's a crystal ball. So I always have to be careful whenever you teach technical analysis, because so many people want it to be this perfect system, this crystal ball. It predicts the future. It's not that. It's basically, see if we can go into the golden ratio. It's more about just improving your probability of success. So if you were to come in and kind of look at these numbers about the golden ratio, see these numbers, they're not even talking about trading. This is still on Math is Fun. But I want to point out two numbers from the golden ratio number, which is 1.618. Notice if you got something like 0.618 or 0.382, those right there are your Fibonacci levels, your retracement levels. And remember, we talked about phi, the Greek letter phi. It's basically these fractional things where you come out with, if you do the math of it, it always keeps coming back to this 1.618, and the big ratios off of that are 618 and 382. If you memorize those two numbers, you're going to see that over and over again in Fibonacci retracements. Well, what is a Fibonacci retracement? If a stock is going up and makes new highs, we can use this Fibonacci retracement idea. If a stock is downtrending and makes new lows, we can use this Fibonacci idea. If a stock is sideways and choppy, we don't do it. If it's just kind of going up, but then it starts to make an equal or a lower high, we don't do it, okay? It's just basically a trend tool. And all it really is saying, okay, the stock has zoomed to the upside, and now it starts to pull back. The question is, where should I buy? Where should I buy the dip? Should I even buy the dip, right? But if I'm going to, where's a good level to buy the dip? Those are your levels. That's basically the Fibonacci zone, or what they'll call the Fibonacci box, where the buyers are likely to be located. If a stock has just made a new low and it starts to pull back in price, the question is, first, should I short? Am I looking to get short? Am I, and if I'm going to sell and sell it short and play it to the downside, the question is where? Where do we do it? And that's what this Fibonacci idea is telling us, is basically that most assets will pull back either 38.2% of the advance or 61.8% of the advance. 38.2, 61.8. What do those numbers mean? And you'll often see a 50 in here. Although a 50 is not a Fibonacci number, it's right smack dab dead in the middle of the two Fibonacci numbers. Well, essentially, it's if a stock goes up 10 points, it will often pull back around somewhere around 38.2 to 61.8. Obviously, you're going to get a 38.2% retracement more often than a 61.8, because a lot of times it'll just pull back to the 38.2 and then go again, right? Sometimes it'll have that deeper pullback all the way back to the 61.8 and then take off. That area basically is where buyers should be located. That is where it makes sense for a lot of buyers to be piled up. Now, why? Why would buyers be in that zone? Well, think about it. As this stock went up, some people might have taken a little profit off as it ran up. As it pulls back, they're like, hey, I can rebuy. I can get back in to what I just took profits in. You have other people that missed the run and they're saying, boy, on the next pullback, I'm going to buy. We want to increase our stake and so on. So you have new buyers. You have short sellers that say, wow, that did not feel good. I was losing on that move. As it pulls back, I want to buy to cover some of this short position and get out at a lesser loss. Maybe I don't give up on the advance, but I'm going to buy to cover as this stock pulls back in price. This is where human emotion is going to tell them there's more reason to buy than to sell in this zone, right? There's a lot of human emotion saying buy, 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 and there's not a lot of reasons to sell. If you were going to sell, you probably would have sold up here, or maybe if the trend breaks down. But here you're in no man's land. This is not a good risk to reward to sell. And so people just stop selling at that level. They're like, well, maybe if it goes back up to the highs, I'll sell. Maybe if it starts to break, the trend, I'll sell. But there's just, you run out of reasons to sell, but there are a lot of reasons to buy. On the flip side, when a stock has gone down and then it starts to pull back, again, a 38.2% retracement or a 61.8% retracement of that move, and there will be a lot of reasons to sell. Why would I sell? Well, I might want to sell something that I bought well down here. I might want to sell short because I was missing the run down, but I said, man, when it rallies back up, I'm going to get short this thing. You could have people that are long and in a losing trade, and as it bounces up, they say, we need to get out of some of those shares. We need to lessen the pain. A lot of reasons to sell, but who's going to buy after the rally? The buyers either had to buy well, or they might wait for the entire trend to change, but it's kind of in no man's land there. It's kind of, not a great risk to reward to buy. Basically, human nature will tell them to stop buying and start selling, right? And so that's the whole approach. That's really Fibonacci retracements in a nutshell, is saying, where are we likely to encounter more buyers or more sellers? Now, if we pull up a chart and we just look at a chart and say, well, okay, this particular chart is the S&P 500, right? And let's really make this clean. I'm going to kill everything else. Not worry about moving averages, not worry about anything but price action. And we just kind of look at this, and you can almost do a sort of dot to dot where you kind of say, okay, price is going up and down and up and down. And, what are these waves of patterns and whatnot? And what we're looking for is where the price action starts to make higher highs or lower lows, right? So we can't really see what was happening back here. I don't remember. It was kind of rallying up or whatever. But we don't know. Frankly, this was probably a great short setup because it probably had made a lower low there. And then this was probably a fib retracement level. So it was probably screaming at you to sell, more reasons to sell, et cetera, et cetera. But anyway, this trend started to reverse. I mean, actually here, there were more reasons to sell. Now, it didn't completely fall apart. It sold off, and then it went choppy and so on. But this was a fib level, most likely, if this was a new low. But let's work off of what we absolutely know. We absolutely know that this was a new high. Meaning not the highest high. No. A new high. You're comparing peak to prior peak. Did this one go above that one? Yes, without question. It's not debatable, right? We made a new high and then pulled back. So we could drag our Fibonacci levels right there, actually, on that peak. So to tell us, okay, where do we buy? If I hit the annotate button and I come in here to Fibonacci retracements and I drag this move, whoops, I guess we want to go bullish, so I want to go this way. Okay, that rally, all we're measuring is, okay, it ran up to a higher high than the prior high. This tells me where to start buying. This says we'll probably pull back to about 38.2, which is what this one did. Maybe it'll get a deeper pullback sometimes towards the 61.8, but this is where buyers should be located. In this case, a 38.2% retracement, and then it took off again. Okay. Now, fast forward, did we make a new high here? Yes. There was no real pullback. I know that none of these kind of pulled back far enough. They were kind of just, if you're drawing dot to dot, it's almost like a pause, but it didn't really dip down in any way. It never really gave a retracement, right? Now, as we go to the upside, you could say, well, wasn't this a new high? Yes. Could we drag some retracement levels? Sure. If you wanted to say, well, this was the prior little swing low, if we use the same type of concept, let's go grab our fib retracement, and if we drag that, this says, well, it should pull back in here. And look at what happens. A lot of times this happens where if you are trying to buy the dip, right? We're measuring this move, and here's where it pulled back 38.2% of its prior advance, its prior little trading range. Well, big bearish candle, so it didn't show any signs of stopping yet. Then it gapped over. So there really was no reason to buy here. It never gave you a setup. That's important. You want to see some stabilization. You want to see a bullish candle. You want to see a pivot. You want to see something. And sure enough, it broke down. Okay. So as it breaks down, we can start to do things in the opposite angle. We could say, well, this wasn't a new low yet, but this one certainly was. This drop was certainly a new low. And so, you know, if we were looking at this from the context of this decline, had you done your Fibonacci's here, this is probably a bearish retracement. Let's just look at it. And again, this is, you understand you can pass on any trade that doesn't meet the criteria, right? So if you said, well, this didn't make a new low, so I just don't trust this one, fine, great. You want to use these retracement levels, but if everything looks good, if everything is in place. So you might say, you know, I'm not sure that this is making new lows yet. Okay, well, this one made a lower low than that one. So now we could drag this trading range, right? All you're doing is measuring the trading range, and then these retracements are kind of an area where you can, in this case, get short because the trend is lower. This one also never gave you a setup because it went through the levels and then it gapped back and took off. You know, it's kind of a little fake out type of move. And that's the S&P 500. You can do this on longer term charts, like you could measure out really long-term trades, or you can do short-term. If we just think about, you know, some of the biggest, I didn't cherry pick. I mean, that wasn't really some like stellar examples or something. But most people will look at stocks like, well, maybe I trade Apple or Amazon or Google or in the energy patch, Chevron and Exxon and Conoco and so on. If you just think about names, the basic idea here is that you're looking for trends. Remember, if you're choppy and going sideways, then we're not really using it. But anytime you're making higher highs. So if we just do comparisons and we say, you know, remember the old dot to dot type of thing. If you were to just kind of draw peaks and valleys, peaks and valleys, peaks and valleys, okay, and then it started to reverse and it started going this way. So you could use your Fibonacci's from here. This is a new high. So what would you measure? You'd measure from that peak to the prior low, and that would spit out your Fibonacci zone in here. And that was probably a 38% retracement. This made a new high, so you can measure here to here, and this would give you your Fibonacci zone. And again, it was probably around 38.2. This made a new high, so you could measure from here to here. This one probably didn't pull back enough because your fib levels would be down here, right? This made a new high. You could measure from here to here to tell you where to buy the dip. And this one might have been a stop out, might have triggered you in and then stopped you out at a loss. Well, you had a couple of really great trades. You had one that didn't trigger, and you had a loser up here. Once you start making new lows, what do? You measure the downside, and this will tell you where to short. And this was probably in that area and started to reverse, and you could be short Apple. This made a new low. So again, you're measuring here to here, and this will give you that fib zone of where sellers should be located. If it fits with the other aspects of it, great. Because remember, all you're talking about is measuring the trading range, and it will tell you where buyers should be located on the dip, or measuring the trading range in a downtrend, and it will tell you where sellers are likely to be located in the bear rally pattern. So let's drag these and think about it. Again, here was a new high, right? So I'll grab my Fibonacci tool, and if I measure this upside move, because here we made new highs, look at where we came back to. 38.2, that's your buy zone. We went to a new high, so I can measure. Once it starts to pull back, I don't start this measurement, right, from the prior low to the peak until this starts to happen. Once it starts to pull back like that, well, now I can do it. Measure from the prior low to that new swing high, and this tells me where to buy the dip. Again, right at the 38.2. Here we went to new highs and we started to pull back or whatnot. Well, it never pulled back far enough. Even if we said, well, here it started to pull back. If you measure from this prior low to the new high, it just never pulled back deep enough in here once you started to pull back a little bit there. If you, again, said, well, this made a new high and it's starting to pull back, we'd go from prior lows down or up to new highs, and it really kind of blew through. I said you'd probably be stopped out. It really didn't give you a setup. It just kind of went through that zone. So now we know if you're weak enough to go through that Fibonacci zone, that's information. It's actually very good information. If you can't stop where the buyer should be located, there's probably more pain ahead, right? If you can't stop where the buyers instinctively and human nature says this is the buy zone on the small pullback, if it gets through there, it's probably going to continue to trend the other direction for a while. So if it starts to trend the other direction, what do? Well, we flip it around and we say, okay, this one didn't make a new low, but this one did. And so now we drag the Fibonacci's and we say, okay, once it starts to retrace, right? And now we're moving down. Once we start to pull back, now we measure the downside from prior peak to the new low, right there, okay? And see how it came right up to the 61.8, and that's where it failed. This is where sellers should be located. It's now making new lows, so when it rallies, there should be selling pressure there. And sure enough, that's where it failed and plummeted down, okay? Now we just made a new low. So we're starting to rally, okay? We could measure from prior peak to new low, and it's going through the 38.2. So this one's not actionable yet in terms of shorting, but imagine you had another bullish day that came up to 61.8, but then kind of failed there and reversed and started to turn back down. Sure enough, that would be a short setup if you like the other aspects of the trade, if you like the other components. If you think that, again, this is just one aspect of the trade. This is just saying, well, where should buyers be located? We need to think about the other things. Do we like the volume? Do we like this chart? Do we like the market conditions? Do we like this sector? We'd have to consider some other factors, but it is helpful to kind of think about this retracement concept. Now, when you're thinking about retracements, remember, it's just retracing back some of your steps. It's mean reversion. And what does that mean? Mean reversion is something that happens in trading in that it make sense that stocks zigzag. And these retracements are telling us how much after the zig it should zag, right? And this is where buyers should be located in an uptrend. But why does this happen? Why do things revert back? Why is there some sort of mean reversion? Well, it's profit taking. When stocks go up, there's naturally a little bit of a supply-demand shift. Demand had control, demand, buyers. But at a certain point, those buyers go, man, this has been nice. I'm going to take some money out. I'm going to go to this side. I'm going to supply. I'm going to start selling, right? And as the price goes up, there will naturally be some sellers that say, hey, I want to take some money off the table. This has been a great run and so forth. So when things make new highs, there's some natural selling that can come in. They move the price up to find sellers for all of this demand. As soon as it shifts and there's more sellers than buyers, well, then the price starts to dip back. But as it dips back, people go, again, it's that thing we already talked about. It's, man, I just sold up here. I can rebuy. Man, I missed that prior advance. It's giving me a dip. It's giving me an opportunity to buy. Man, I was short this and getting my face ripped off. It's pulled back some. I better close. I better buy to cover some of my short stock position. The reason that mean reversion works, and when you pull up charts, you see the zigzags, right? In an uptrend, you see zigzags higher. In a downtrend, you see zigzags lower. That's constantly Fibonacci retracement levels in play. I mean, that's really what it is. It's fib levels over and over and over again in terms of trading. So as we look at this and as we kind of consider the different aspects of Fibonacci retracement levels, you can start to understand why Apple might encounter some sellers as it rallies. Well, this has not been fun for buyers. So as it rallies, they may want to sell and reduce some of the pain. This has been fun for short sellers. Now they might have been buying back some of their shorts, and then they might reinitiate their shorts here, et cetera, et cetera. So in terms of trading, that's how they work. Now, you can do these on a variety of different time frames. If you were to look at long-term charts, and I don't dislike this. I mean, if you were thinking really long-term, you could go to a weekly chart. Now, I just switched the stock. I went from Apple to Amazon. But if we just look at something like Amazon or whatever, I don't really care what the stock is. In fact, Apple and Amazon might be too similar. Let's go Nvidia or something, okay? This is a chip stock and highly volatile. Well, can you see periods? I mean, you notice all the zigs and zags, right? But if you're looking at this in context and kind of saying, okay, when we start to have real pullbacks, I mean, like this is obviously a real pullback happening here, right? It started to go down for a few weeks. But we say, okay, this was a new high, meaning higher than prior highs. And so if we were to measure this and say, well, here was the new high, let's go back to the prior low and measure it out, this probably pulled back towards a fib level, So if we measure to this new high and it pulled back, it was volatile, but it came back to that 61.8% retracement and then took off again. As it took off again, there's probably not enough pullback in here to even give you an opportunity, but there certainly were on these ones. Here it started to zig and zag a little bit more. So if you look at it like this was a new high, okay, so we measure that upside move and see how it pulled back right there into that 61.8 and then took off again. This, pulled back for a couple of weeks, right? It ran higher to a new high, then pulled back into that zone. Well, this one started to pull back. So you measure that move. You go from the prior low, so this new low, to that high, and sure enough, pulled right back to that fib level and took off again. This one made a new high. So we measure, okay, from that low to the new high, and sure enough, right into that zone and took off again. I mean, there's three. These don't look like much, but remember, this is a 4 or 5 week pullback. This is now a weekly chart. This is a 3-week pullback. This is a 6-week pullback. And all three of those pulled back. Let me draw the the trading range. I'll make the trading range blue. Here's what we advanced, and we pull back into the fib zone. Then we measure from that to that, and that was pulled back to a fib zone. And then we measure from that new swing low up to the new high once it starts to pull back, and that's the fib zone, right? Once you start to reverse and start to downtrend, well, then things go the other way. Now, once it starts to retrace, see this retracement, we measure down from prior peak down to those new lows and see if that gives you a short setup. Okay, well, let's do it together. Let's take a look. So I grab my fib levels, measure it on down, and sure enough, right into that fib zone. See that? A screaming short setup. It had rallied for 3 or 4 weeks up, right? After a 10 or 12 week decline, rallied up for a few weeks, short setup, and away we go. I mean, what a great short set. Just like these were great buy setup, great buy setup, great buy setup, here you had a great short setup. If you missed that one, okay, let's say you missed it. So we'll kill that. This clearly made a new low, and then it started to retrace. So what would we measure? From prior peak to that new low, and we're starting to look at that retracement to say, where do I get short? Where do I sell? You know, that idea. Well, this one didn't rally enough. See, if we measure that trading range down, this one never bounced up enough to get into that Fibonacci zone. So you can use this on different time frames. I mean, that's a longer term weekly chart, but the same principles kind of apply in terms of the trades. This obviously would be for a longer term trader slash investor or whatnot, because if you got triggered in here, you're not in for a couple of days. You're targeting a multi-week, multi-month move, right? You are waiting 3 weeks on the pullback and so on. You're expecting to be in this for multiple months if you're on a weekly time frame. That's why a lot of traders are using more of the daily. They're saying, well, I'm not expecting to be in it for weeks on end. I'm looking for these daily setups, you know, these shorter term pullbacks, and to trade it for the next week or 2 weeks or whatever, a little bit shorter time period that way. So as we look at these fib retracement levels, again, the important point of you're measuring after new highs or you're measuring after new lows, right? New highs and new lows is where the fibs come into place. You wouldn't measure anything here, like this is not a new high compared to that one. This you're not measuring, this did not make a new low compared to that one, right? But here you can start to measure. You say, okay, well, this plummeted to a new low, a lower low than prior lows. So I could measure this downward slide to say, well, did this rally give me a short setup? You know, this is where I'd want to get short if it meets other pieces of criteria. So let's look. Did NVIDIA recently give a short setup? So here was the trading range on the downside. I wonder if it was just not quite a big enough rally. Had it filled the gap right there and just rallied for another day or two, would have been right hitting a fib level. Not enough of a rally, and then just started to turn down. Sometimes that happens, right? Just didn't give you the right setup. Over here, by the way, you had a setup because we made a new high, higher than prior high, okay? So we could measure this, right? Once it started to pull back, we know where the high is. Once it starts to drop down, we're interested in buying somewhere in here. Let's see if it gave us a setup. So we grab our fib tool, we measure that move, and yeah, pulled right back into that fib zone and then started to pivot higher. You absolutely could have been trading this, getting in here maybe on the pivot up and trading, and should have done pretty well. I mean, we certainly advanced over the next few days, and made an even higher high, right? It kind of told you where buyers should be located, and sure enough, that's where they were to drive the stock higher. That's the approach. Fibonacci retracements. It's mean reversion. You're taking, 10 steps up and 3 or 4 or 5 or 6 steps down. More specifically, it's about 4 to 6 steps, because this is almost 40%. This is about 60%. So if you think about it, it's kind of take 10 steps up and you'll pull back about 4 to 6. That's the zone. You pull back around 50%. If you give back around 50-ish% of the prior advance, you're right in that fib zone. 2 steps up, 1 step back, 2 steps up, 1 step back. That sort of approach is what it really is. You're retracing your steps. Now, there are Fibonacci extensions and a variety of different things that you can utilize for targeting. Expectations, like a lot of people will use that 1.618, that golden ratio. That's what the whole 38.2, 61.8, it's all based upon. These are your 3 key numbers, basically. Well, they'll often use that golden ratio number of 1.618 to target the upside. Basically, it's a big target, but it says, from where we're at, we could go this far. And the tool I like to use is actually at Interactive Brokers and using their charts. So if you pull up, let's just pull up a chart here. And if you were to look at this, I mean, you can go on a variety of different time periods. Let's go pull up what's something that's kind of trendy and volatile or whatever. Let's say we were going to trade Zillow or something, and that's pretty choppy of late. And what's something that's volatile? Let me think here. I mean, we were looking at Nvidia, AMD, certainly volatile. So problem we've been in is it's been a little bit of a choppy market, but let me just kind of show you from back here. Like back here, obviously we were making some new lows in price, right? Like this is clearly lower than prior lows made. So let's say that you are gonna, okay, we made a new low and we started to retrace. Well, we can measure this downside move, can't we? We can measure that and say, well, where should this go? If you go into the Interactive Brokers charts and we right click, we can add Fibonacci lines. You see that? And as we do that, as I grab and drag, it will put in those retracements. But it also puts in the extensions. Do you see that? So I measured this move, and it tells me where my fib levels are. So here is 38.2%. This one came up to a 50%, right at 50, right? There's 61.8. So this is your fib zone, where sellers should be located. This was the new low that we made. We started to retrace. So we measured from prior peak, to the new low, and this came into the Fibonacci zone. But not just the retracement. Notice it gave you the extensions, and it says, here are some potential targets. So yes, you're getting short, you're bearish, right? You expect the trend to persist, which is down. But where do you target? That's the question. Well, it gives you some targets, and one is pretty normal. I mean, this is a big target, by the way, 61.8. This one is crazy big. I mean, this one is, you got to wait months, right? That we're back to, this is a long-term target. But notice how it came to that target, and that's where it bounced. And over time, I'll be darned if months later, it didn't get right to that target. And that's where it ended up bouncing, And there's some I don't know if it's sort of magic or what, but a lot of institutions, you hear about these professional institutions that will have automated trading systems. Go read books about Jim Simons, who is probably the only human that's done better than Warren Buffett and so on. They program stuff, and oftentimes they'll use mathematics, Fibonacci sequence, etc., to basically tell them, okay, here's how human nature works. So they'll have systems for, shorting or buying, and it's automated process based off of the mathematics, and then they'll have targets. And so somebody asks, why do these levels work? It's kind of a chicken and egg thing. Does it really work because it's human nature? Or does it work because enough humans believe it's going to work, so they act that way? It's probably a little of both. Like human nature tells you when something's retracing, when there's some mean reversion, hey, here's where I should be selling, not buying, right? There's just some natural pressure that shifts. That's true. But then there's also a certain self-fulfilling prophecy. If enough people kind of use this system and line up to sell at these levels and then set their targets and so on, there's gravitational pull. If you get enough people convinced it's going to work, it's going to kind of play out that way because there will be a lot of selling and not as much buying. So anyway, that's kind of the process of it. But if you look at, here's an interactive brokers chart, which if you look at the targets on this, they're pretty darn aggressive. Just be aware if you're using fib extensions, the extension levels, they will be quite aggressive in how far they go. A question that we get quite often, which is, can I use shorter time frames? Could I go into intraday charts? Could I day trade this concept? Less trustworthy, but yes. I mean, the same principles apply, but a little less trustworthy. And so if we were to look at this, I mean, could you go into an hourly or a 15-minute chart or a 4-hour chart or whatever and do the same thing? You can, but it might be a little less trustworthy. So I would at least probably go 4-hour. I wouldn't probably get into the 15 minutes as much. I would use a little bit more time period for this trading concept. And if you're using a 4-hour chart, it's not even necessarily that you're going to be day trading because you're probably still going to be in for a few days. But let's look at it. So here we can see that something is retracing, correct? This is pulling back. It's looking for pullbacks, and in this case, in an uptrend. So if we were to measure this trading range, this is the retracement of that range, correct? So we would drag our fib levels. I'm going to right click, add a Fibonacci line. Okay, drag that in here. And sure enough, look at where it retraced. 38.2% of that advance. This made a new high. This retraced back some of that prior advance, right? And that's the buy zone. Great trade, happened to work, nice upside. And the reason I say a 4-hour is, notice by using a 4-hour and not like a 1 hour or a 15-minute. If you use a 15-minute, you're going to be in and out the same day, which is a day trade. If you use the 4-hour and you bought here at 85, you bought on this date, which was July 26th. You could still be in this. The next day it opened up. This was July 27th. So you were buying around the close. The next day you could have bought in, or maybe you were already in. There's the 27th, which is those bars. There's the 28th. There's the 29th, and so on. If you are targeting this extension, you could have been in this for a few days, a couple of weeks. So perfectly fine to use the 4-hour chart, and you're not even probably day trading if you use the 4-hour chart. But you would be day trading if you get into like using the 15-minute. And again, less trustworthy. So I don't mind using a 4-hour chart, or maybe even an hourly chart sometimes. Look at the 15-minute though. I mean, You know, it's going to be very quick and rapid and so forth. Now, obviously, in here, you're making new lows, but you didn't get a retracement until here. So I don't know that that was enough. It wouldn't have been if you had gone and measured this prior decline, right? That peak to that decline. It never came up into this fib zone. So there just wasn't any actionable opportunity. But notice here that now you probably are in and out the same day. Had you been triggered in, I mean, this is all September 14th, all of these candles, right? So it'd be trading on a much quicker time frame. I don't mind going into a 4-hour. And actually, if you are going to swing trade, meaning you're going to be in for a couple of days, Fibonacci retracements usually are more like if I use a daily chart, I'm going to be in for days, if not weeks. You know, if I use a 4-hour, I'm probably not going to be in for multiple weeks. It's going to be shortening up that time period, but I'm still probably going to be in for a couple of days at least. And if it's really working, I might even be in for a few days like this one. Had it not worked, well, I might have been stopped out the very next day. But again, I'm not day trading it. So you can use this on a variety of different time periods. And again, it's a mean reversion concept and idea. You're retracing back some of the prior steps. All right, we'll leave it there. Thanks everyone for joining us today on this class on Fibonacci retracements. I hope you enjoyed the content. I feel like you learned some new things and can use that a little bit more effectively in your trading. Remember that Fib retracements can be on a variety of different time periods. They're a great approach to mean reversion, asking the question, where do I buy the dip or sell the rally? Those are the Fib levels, and they can be something that can help you to improve your probability of success. Visit us at Maverick Trading. Thanks everyone for being here. We'll see you next time. Goodbye.